With the rise of online shopping, brick and mortar retail companies have been getting crushed. And while e-commerce sales have been soaring to record highs, mall traffic has pretty much flatlined. As a result, stocks that are heavily exposed to mall traffic have been falling off a cliff, while their dividends have soared to very high yields. So are these great value dividend stocks to consider, or are they value traps waiting to snatch up any unsuspecting investors? Well, in today's video, we're going to take a look at three very popular ones in Macys, Nordstrom, and L brands, and I'll give you my opinion on each of them. So I hope you guys enjoy this video. If you do, don't forget to hit the like button, and let's go ahead and get started. What's up everyone, my name is Ale. Welcome back to my world of stocks. Okay, before we start, I just got to give you my quick personal thoughts on retail investing so that you know kind of where I'm coming from. I personally don't really like investing in retail stocks at this time. I'm much more of a growth investor who believes in investing in companies that are the disruptors rather than the ones that are being disrupted, even if they can kind of survive the changing trends. So for example, I'm heavily invested in Amazon because they are, a disruptor. Having said that, I fully acknowledge that a lot of my viewers are much more value oriented or even dividend oriented. And so I think to be successful in the market, you always have to have kind of an open mind and look at stocks objectively. So that's what I'm going to try to do in today's video and just give you my honest thoughts on these three stocks and just give an objective kind of viewpoint on all three of them and let you know if I think there's any kind of potential there, if I feel like they're surviving the so-called retail apocalypse, or if I just think they're all just kind of doomed to fail. I'll give you kind of my thoughts. And to make the video even more fun, at the end of the video, I'm also going to pretend like you guys are forcing me to invest in one of these three stocks. So I'll choose one stock to kind of figuratively invest in for myself. So that'll make it kind of fun, but that'll be at the end of the video where I just kind of summarize all three and I pick one that I think is the better option. But having said that, if you're still with me, let's go ahead and start with the first stock on our list, and that's going to be Macys, ticker symbol is M, and let's go ahead and take a look. Okay, now their business mostly revolves around their retail sale of clothing, shoes, cosmetics, fragrances, and other home and miscellaneous products. And the brands or stores that they own include Macy's, Bloomingdale's, and Bluemercury. And obviously these are all a bit higher end stores that you typically find at the mall, although Macy's has recently implemented a store within a store called Backstage that sells for more affordable prices. And I think it's a great way of appealing to the two different kind of market types. Regardless, when looking at their stock, we can see that they've had horrible long-term performance that is mostly due to the damage that they've taken over the past 5 years, where the stock has dropped by over 70%. More specifically, the stock was actually taking off after the last recession and reached record highs of over $70 a share back in 2015 before falling off a cliff and dropping by close to 80% all the way down to just $17 a share at the time of this recording. That correlates almost entirely with their drop in sales that also took off after the last recession, peaked in 2015, and then went into a decline almost every year after. And things are only expected to get worse in the future as revenue growth is projected to be slightly negative in each of the next 2 years. More importantly, the drop in sales is going to put even more pressure on their pricing that will in turn hurt their margins, as their EPS is expected to drop by over 30% this year, close to 8% next year, and average negative 15% over the next 5 years, which is about 5 percentage points worse than what it was in the previous 5 years. So this is a very dark picture that is being painted kind of overall. Granted, a lot of this earnings pain is coming from mistakes in inventory management that they've talked about in the past and that they claim to be addressing by forming a new partnership with Google to better manage their inventory and improve efficiency. And they're also heavily exposed to the ongoing trade war through their supply chain that would obviously improve dramatically if a trade deal ever gets done with China, which I do think will happen eventually. Still, the growth of online shopping, in large part thanks to the rise of Amazon, has been surging in recent years while adding pressure to traditional retail. In fact, online sales are growing by tens of of billions of dollars in the US, while still making only around 10% of all retail last year. And meanwhile, US chain store sales, which is basically department store sales, including places like Macys, have been trending downward for years. As a result, we've seen many retailers close thousands of brick and mortar stores every year, and since 2015, closures by square footage have been rising every year as well. However, that doesn't really paint the entire picture. See, store closures can fluctuate every year depending on who goes bankrupt, taking down thousands of stores on their own, and who is actually performing well and decides to open new ones. So it's therefore important to look at every company specifically and see what their net store count is like. Well, in Macys' case, it's been a little up and down in recent years, but it's not really all that bad. In fact, it's been climbing so far since 2017. I expect those numbers to come down due to an increased focus on cost cutting, but the point is that their store counts don't really paint as ugly of a picture as other retailers out there. In fact, one of their best performing stores is Blue Mercury, that sells cosmetics and even offers spa services, drawing comparisons to other very popular cosmetic stores like Sephora and Ulta. And ever since Macys acquired them, they've grown their store count from 63 in 2015 to 167 so far this year, with double-digit sales growth last year and over 50% online sales growth to go right along with it. And I'll just finish up here by noting that their free cash flows have slumped down over the past 5 years, but still hover over $1 billion a year that they've been using to pay down their debts and invest in their online infrastructure. In fact, all of their major businesses, including Macys, Bloomingdale's, and Blue Mercury, have growing online stores that utilize physical stores for fulfillment that they claim saw double-digit revenue growth in each of the past 38 straight quarters, which by the way is up to 40 now, and that's with $1 billion in sales just through mobile apps alone. I couldn't find exact figures on how much of their sales are digital, but growing them at double-digit rates for 40 straight quarters is very impressive no matter how you look at it. Meanwhile, their valuation has gone much cheaper with a forward PE ratio of less than 7, with a PS ratio of just 0.2. Their dividend has also skyrocketed to almost 9%, and even at that height, their payout ratio is still less than 50%. However, their balance sheet could be better as their current assets are not enough to cover both their short and long-term debt, which can potentially be a problem when your sales are no longer growing. And during their last earnings call, analysts asked about the dividend, and while they did say that they are committed to paying it, they also noted that there are other priorities higher up on the list, like investing in growth and paying down debt. Not to mention that the stock is really cheap right now, so it wouldn't be a bad time to actually buy back shares if they really think that they can turn things around, which they also hinted at during the earnings call. And if you look at their dividend history, they haven't grown it in years, which is understandable considering the high yield and low sales growth, but it has been paid for a pretty long time, although they did actually cut that dividend during the last recession, which makes it more risky whenever we get the next one. So overall, I think there's just too many concerns when looking at Macys to really consider them a good value stock. Now, having said that, I actually like a lot of the changes that they're implementing, and I like what they're doing with Blue Mercury. I'm actually, I think that that's going to be a very good part of their business. I really like what they're doing with Backstage, and I like how seriously they're taking their online kind of strategy and putting up some good growth numbers for, a decent amount of time already. Having said that, I still think that there remains a lot of risk in this stock, even at the lower valuation. But before we give kind of a final judgment, let's go ahead and take a look at the other stocks and see how they compare on the list. So now let's transition to Nordstrom, and that ticker symbol is JWN. Now, when looking at Nordstrom's business, that mostly involves 5 different brands, with the 2 biggest being Nordstrom and Nordstrom Rack. One is the full-on higher-end department store, while Nordstrom Rack offers cheaper options, which is a great way of catering to the 2 different markets, similarly to what Macys does with Backstage, but in a bigger way. Now, unlike Macys, Nordstrom does clearly show you what percentage of their sales are digital, and to my surprise, it's pretty high at over 30%. All of this tells me that Nordstrom is putting some serious effort into adjusting during the so-called retail apocalypse. It's also translated to more consistent growth than Macys over the past decade, although they do about half the numbers. Admittedly, this is still very tiny growth, but it's growth nonetheless, with only 1 year being an exception, and that was during the last recession. Unfortunately, that sales growth is expected to end this year, as analysts are projecting negative revenue growth growth of 2.1%, which is a bigger drop than Macys, by the way, but they are at least expected to return to growth next year at almost 2%. And while their EPS is expected to drop by almost 9% this year, that's expected to start recovering next year and still average about 4% growth over the next 5 years. That's much better than the negative 15% that is expected from Macys. And better earnings may translate to a more sustainable dividend that already yields over 4% with a payout ratio of about 45%. Granted, that dividend hasn't grown over the past few years, but it has at least been paid every year for decades and wasn't even cut during the last recession, which is pretty impressive. Keep in mind that that was at a time when they actually had negative cash flows, so to me that shows that they are pretty dedicated to paying those dividends. On the other hand, those cash flows have been going down every year since 2016, although they're still kind of decently high. In any case, their sales growth started to really slow down in the years following 2016, right along with their declining profitability, and that's mostly reflected in the stock price that peaked around that same time. Now, they did recover last year, climbing to as much as $67 a share, but because of the negative sales growth projected this year, coupled with all of the other macroeconomic concerns out there, the stock has now crumbled, dropping by around 50% to just $34 a share. That made the valuation much more attractive, as they now trade for just 10 times forward earnings with a PS ratio of only 0.35. Their balance sheet is pretty bad though. In fact, it's much worse than Macys, considering that their current ratio is well below 1, which is something that I never like to see. Still, their performance has been more stable throughout recent history, and they still have certain parts of their business that are performing very well, like their online sales growing by 16% in their last fiscal year, while their net store count actually increased thanks to their off-price business that is made up of Nordstrom rack stores that are bringing in the highest growth to make up for the weakness in their higher end business. So overall, I actually think that Nordstrom is doing a lot of positive things here, and they kind of look like the safer option just based off of their performance so far and kind of what is expected from them, even though I think Macys does have a lower valuation, a higher dividend, and a better balance sheet. So it's kind of a close one there, but I think Nordstrom looks like probably the safer option out of the two so far. But before we announce a winner here, we should take a look at the third stock on our list and see if they can put up a challenge, and that's going to be L Brands. Ticker symbol is LB. Well, when looking at their business, that revolves around Victoria's Secret, which is like a higher end lingerie brand that also sells fragrances and cosmetics and a few other apparels. They also have Bath & Body Works, which is a very popular and growing brand that sells all kinds of bath and body products. And then they also have Pink, that is a smaller brand targeted towards college women and sells different apparel and accessories. Now, when looking at their performance, they're similar to Nordstrom in that their sales dropped during the last recession, but then also grew very slowly but consistently in all the years to follow. However, their free cash flow is down quite a bit from their highs in 2016, so the falling cash flows coupled with the stagnant sales have caused the stock to suffer. Back in 2016, they traded for close to $100 a share, but have since crashed by around 80%, all the way down to just $18 a share. The valuation now sits at just a forward P ratio of less than 8 with a PS ratio of 0.4, while their dividend yields as much as 6.3%, which is very high. Their payout ratio is also pretty high though at 62%, and their balance sheet isn't very inspiring, as their current assets cannot cover both their short and long-term debts, nor can their total assets cover their total liabilities, as they have a total ratio that is less than 1. That's definitely a concern, as future funds will need to go towards paying down that debt. Still, they've been paying that dividend since the 80s according to Seeking Alpha, and it doesn't look like they've ever cut it either, even during the last recession. That is until the end of last year, where L Brands decided to finally cut their dividend in half. Still, with a yield above 6%, the dividend is very attractive, assuming that it doesn't get cut any further in the future. But speaking of the future, L Brands revenue is expected to actually drop by 1.3% this year, but are also expected to return to growth next year by 2%. And while their EPS is also expected to get crushed by over 13% this year, they also expect that to recover next year and still average positive 6% over the next 5 years, which is actually better than both Macys and even Nordstrom. But when looking at their business, the majority of the revenue comes from Victoria's Secret at 55% of sales, but that business has been bleeding for a long time now, and the only reason that they've been kind of surviving is thanks to Bath & Body Works. As you can see on this chart here, that Victoria's Secret growth has been negative in each of the past 5 quarters, and it only gets kind of worse and worse in every single quarter, while Bath & Body Works was holding strong growth before the last quarter, where it dipped below a double-digit percentage. The poor performance has led to the planned closure of over 50 Victoria's Secret stores this year in the US and Canada, although they are opening more stores internationally, which, to be fair, may actually provide some growth in the future. And while I found it very difficult to find any mention of their online strategies in their earnings reports, I did at least find this section that mentions direct sales, which I assume is code for online, and that made up around 20% of sales, if I'm reading it correctly, which is, pretty high, so maybe there's actually some potential there as well. Still, in my opinion, it looks like L Brands is probably the weakest and riskiest option out of the 3, and a big reason why is because I happen to know nothing about women's kind of fashion and clothing trends, so it makes it very difficult for me personally to understand their business and their competition. But couple all of that with what is, in my opinion, the weakest balance sheet out of all 3, the weaker kind of business in my opinion, and also the fact that they were willing to cut their dividend in the past already and very recently, and the fact that they'll probably have to cut that dividend in the future because of their higher debt levels, and especially if we go into a recession, which a lot of people keep talking about. And I think that it's kind of obvious that this stock is probably the riskiest out of the 3, and so for me, I would want to stay away from this one. But if I was forced to pick one of these 3 stocks to actually invest in myself, it's a very tough one, but well, I think Nordstrom is actually the safest pick out of the 3. I think some people would disagree. Maybe some people would feel that L Brands is a stronger pick because they may feel like they have a stronger brand with Victoria's Secret and with Bath & Body Works, but I think that Nordstrom and Macys are kind of strong brands on their own, and I really like what Macys is doing with Blue Mercury, and I think there's a lot of potential there. And then I also like the fact that they have Backstage, which is kind of like a store within a store, so it kind of draws in traffic to the main store as well, so it's kind of killing like 2 birds with 1 stone almost. And they've mentioned that Backstage has actually increased the sales performance of their main stores whenever they implement it in, so they're kind of trying to ramp that up. And also, Macys also has the lowest valuation, and it also has the highest dividend yield, which if these 3 stocks are oversold at this point, maybe Macys might be kind of a higher probability that one is oversold the most because of the really low valuation and the really high dividend. But it's also kind of, it's a very risky one because it's at risk of cutting that dividend. I think that dividend will probably get cut in the future, especially if analysts are correct in predicting that they're going to see EPS declines of average like 15% over the next 5 years. Now, granted, a lot of that is due to this year. So if the stock has really suffered because of this year, and it's reflected in the stock price, and then later on they start to kind of recover and that average kind of balances out because of recovering, then potentially there's a little bit more upside there. And I'm not sure if I'm making sense in explaining this. It's kind of hard to explain, but the reason why I think I would probably actually go with Macys is because I think there may actually be more upside potential. I think all 3 are risky no matter how you look at it. I really believe that all 3 are very risky. So if I'm going to take the risk, I feel like I might as well go with Macys, who has the lowest valuation and a really nice dividend to go along with it, which even if it gets cut like in half, you're still talking about like a 5% yield, which is even higher than Nordstrom at the current moment, and Nordstrom hasn't even cut that dividend yet. So for those reasons, I think I would probably invest a very small amount of money into Macys, very small amount, so that I limit my exposure and my exposure to the risk, and I still have some decent upside potential because of the really low valuation and the really high dividend. And by the way, I should probably disclose that I might be a little biased with Macys because I actually like to shop at Macys. Whenever they have sales, I feel like you can get a pretty good deal, and I actually buy all of my Levi's jeans from Macys as well. So I kind of like Macys, and I have a little bit more exposure to it. So for me as an investment, it would make a little more sense to go with Macys because I might be able to understand their business a little bit more because I actually shop there on occasion. So for me, Macy's is probably the one I would go with. That I never shop at Nordstrom, never shop at any kind of L brand stores. Anyway, let me know what you guys think down in the comments section. Are you guys invested in any of these? Do you agree, disagree with anything I said? And I don't know, I'd love to talk to you guys about it. So let me know if these are stocks that are on your radar, if you keep an eye on them. Honestly, I do keep an eye on Macy's, and I don't know, maybe at some point, maybe I might consider giving them a shot, but at this point, I just don't want to be investing in any kind of companies that are at risk of being disrupted by the disruptors. And I actually think that you'd probably get a bigger return with Amazon, even with the really high valuation that Amazon carries. I think over the long term, it probably outperforms. But anyway, we'll have to see what happens. Thank you so much for watching. I hope you guys enjoyed the video. If you did, make sure you hit the like button and subscribe if you haven't already. I'll catch you guys in the next one. Take care. Bye-bye.